Hi there, I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Siemens Energy, a global leader in power generation, transmission and renewable solutions. From gas turbines to wind energy via Siemens Gamesa, the company is deeply embedded in the energy transition. The big question is, does the stock offer real long-term value today? We'll break down Siemens Energy using our 5 key factors. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. If you find this helpful, hit like and subscribe. Now let's jump in. We look for companies leading their industry in capital returns, showing they know how to turn investments into real profits. Comparing Siemens Energy to its peers in energy and industrials gives us the clearest picture. Return on invested capital is minus 0.1% for Siemens Energy, reflecting recent operational struggles, especially in Siemens Gamesa. GE Vernova is slightly better at 1.7%, though we only have one data point for GE Vernova. Schneider Electric sits at 9.5% and ABB leads at 14.7%. Siemens Energy has a return on equity of 13%, slightly below Schneider at 14.6% and well below ABB, which leads the pack at 26.9%. GE Vernova comes in at 16.4%. Again, only one data point, so take that with caution. Siemens Energy's returns on capital are modest compared to its peers. ABB clearly sets the bar, while GE Vernova and Schneider sit in the middle. For investors, this shows that while Siemens has scale and technology, it still has work to do in efficiently converting capital into profits. Can Siemens Energy deliver meaningful earnings growth? From 2019 to fiscal year ending 2024, revenue has been growing at a compounded annual growth rate of 3.7%. Net income has been growing at a CAGR of 49.5% and earnings per share has been growing at a CAGR of 44%. The gap between net income and earnings per share growth comes from share dilution, with shares outstanding growing with a 3.3% CAGR. But why has revenue growth been so modest at only 3.7%? Siemens Energy works in capital-intensive, long-cycle projects like turbines and grid infrastructure, where revenue is recognized over years, not quarters. Siemens Gamesa's operational issues such as technical problems, cost overruns and supply chain disruptions have delayed project execution and held back reported revenues despite strong order inflows. Growth in renewables and transmission has been partly offset by declines in traditional power generation, creating a mixed top line. Management has deliberately focused on improving profitability and cash flow, rather than chasing top-line expansion. The result? Modest revenue growth, but explosive earnings growth as margins improve and efficiency gains kick in. Looking forward, a record order backlog and the global push for renewables and grid upgrades support steady growth, though Siemens Gamesa's execution risks remain. Strong growth is only sustainable with healthy financials to back them up. Cash and short-term investments sit at 6.4 billion euros and total debt at 3.8 billion euros. This means Siemens Energy can easily cover its total debt with cash on hand. Debt to equity is healthy at 0.4 and trending downwards from 0.5 in 2023. With free cash flows of 1.4 billion euros, this results in a healthy free cash flow to total debt ratio of 36.8%, where 10% is the bare minimum. Even great companies can make poor investments if you overpay. So how is Siemens Energy valued today? Siemens Energy trades at a price to earnings ratio of 87.6. GE Vernova sits at 150.8 and Schneider Electric and ABB at roughly 29. So Siemens Energy is cheaper than GE Vernova, but far more expensive than Schneider and ABB. Let's add the PAG ratio, which compares price to earnings growth. Forward earnings per share growth based on long-term analyst estimates is 42%. This results in a PAG ratio of 2.1. A PAG above 2 usually signals overvaluation. so Siemens Energy trades at a premium and investors may be paying up for its role in the energy transition. Does Siemens Energy have a strong moat that can protect its future profits? A strong point about Siemens Energy is that it has scale, technology, and a broad portfolio across both conventional and renewable energy. Siemens Gamesa provides a strong position in wind, where ABB and Schneider are weaker. Compared to GE Vernova, Siemens Energy has a more balanced European and global mix and stronger grid infrastructure exposure. Competition is fierce, but Siemens Energy covers all bases: renewables, conventional power, and grid solutions. That makes it more resilient than companies that focus on just one area, like pure play wind or other renewable energy firms. Before we wrap up, the detailed financial charts in this video were powered by Fiscal, my go-to investment research platform. Use my affiliate link below for 15% off to level up your stock research at no extra cost to you. Here's what our 5 key factors reveal about Siemens Energy stock. A return on invested capital of minus 0.1% and return on equity of 13% is low compared to peers, showing weak capital efficiency. Revenues grew at a CAGR of 3.7%, weighed down by Siemens Gamesa and legacy power. But earnings per share grew at a strong 44% CAGR. 6.4 billion euros in cash versus 3.8 billion euros in debt, with a declining debt-to-equity ratio, results in a very healthy balance sheet. A price-to-earnings ratio of 87.6 and a PEG ratio of 2.1 tells us the stock is overvalued relative to growth. Its moat is stronger than Schneider and ABB in renewables, but comparable to GE Vernova, with diversification as a key edge. In my view, Siemens Energy has great positioning for the energy transition. But low capital efficiency and high valuation suggest caution. What's your take? Overvalued or a no-brainer in the energy transition? Drop a comment, hit like and subscribe, and let me know which stock you'd like to see next. Thanks for watching, and I'll see you in the next one.